What if the money moving through your daily life, your paycheck, your bank transfer, your online purchase, is already part of a vast digital infrastructure most of us never see? Beneath familiar apps and account balances, a sophisticated network of payment rails, distributed ledgers, regulatory frameworks, and real-time settlement systems is steadily reshaping how value travels across the global economy. Welcome to Relaxing Facts Studio, where we take a calm, documentary approach to complex systems that quietly power modern life. In today's episode, we'll explore how digital currency infrastructure is transforming global financial systems clearly, carefully, and without hype, so you can better understand the architecture behind the future of money. The United States' journey from traditional banking to a fully digital currency infrastructure is a story of technological evolution reshaping how money moves. Electronic banking set the foundation. ACH systems and wire transfers created the backbone for moving large sums efficiently across institutions. But the real breakthrough came with real-time payment rails, allowing instant transactions that were once unimaginable, transforming payroll, bill payments, and business settlements into seamless, immediate processes. Payment processors and clearinghouses act as the invisible conductors of this complex symphony. They ensure that every transaction is verified, reconciled, and settled accurately across millions of accounts. By coordinating large-scale operations with precision, these intermediaries reduce errors and prevent systemic delays, making the digital economy reliable for both consumers and institutions. Security underpins everything. Modern financial networks rely on advanced encryption, distributed databases, and redundant systems to protect digital value flows. Cyber attacks are constant threats, and robust architecture is essential to prevent breaches that could compromise billions of dollars. From multi-layered authentication to failover protocols, the systems are designed to maintain trust and continuity even under extreme pressure. Yet scaling these networks remains a challenge. Throughput limitations, latency issues, and interoperability gaps between legacy systems and new platforms create bottlenecks. Engineers constantly innovate to increase capacity, reduce transaction delays, and ensure that cross-platform payments remain smooth and secure. The result is a digital infrastructure that not only supports today's financial demands, but also paves the way for the next generation of digital native currencies in the United States, setting a global benchmark for speed, security, and reliability. This transformation is not just technical, it's reshaping how Americans experience money every day, from instant paychecks to secure online purchases, redefining trust and efficiency in the nation's financial ecosystem. Imagine a financial system where your payments are instant, secure, and fully digital. This is the promise of central bank digital currencies, or CBDCs, in the United States. Unlike traditional money, CBDCs come in two distinct forms: retail CBDCs, designed for everyday consumer use, and wholesale CBDCs, engineered for banks and large financial institutions. Retail CBDCs could allow instant peer-to-peer payments, reducing reliance on cash or credit cards, while wholesale CBDCs would streamline interbank settlements, slashing transaction times from days to seconds. CBDCs don't just move money faster, They reshape how monetary policy operates. Digital channels provide central banks with real-time insight into liquidity flows, enabling more precise control of interest rates, money supply, and economic stabilization tools. This immediacy could revolutionize interventions during economic shocks, making responses faster and more targeted than ever before. Security and compliance are central. Advanced identity verification systems, layered digital IDs, and authentication protocols ensure every CBDC transaction meets Know Your Customer, or KYC, and anti-money laundering standards. Consumers gain trust in the system, while regulators retain oversight without slowing down transactions. Integrating CBDCs with existing banking infrastructure is equally transformative. Legacy core banking platforms can interface with digital currency networks, allowing seamless adoption without massive system overhauls. Banks can continue to manage accounts and deposits while offering instant, blockchain-backed settlement options. The result is a financial ecosystem where speed, transparency, and security coexist. Everyday Americans could experience instant payroll deposits, frictionless online shopping, and safer peer-to-peer transfers. At the institutional level, interbank operations become more efficient, resilient, and cost-effective. CBDCs are not a distant experiment. They are a blueprint for a modernized, digitally native financial system, offering benefits that are tangible, measurable, and poised to redefine how money works in the U.S. economy. Cross-border payments are evolving at lightning speed, and blockchain settlement systems are at the heart of this transformation. Traditional international transfers rely on multiple banks and intermediaries, often taking days and generating high fees. Blockchain changes everything by using distributed ledger validation mechanisms. Consensus models like proof of stake or federated validation allow transactions to be finalized without a central clearinghouse, dramatically reducing delays and increasing transparency. Every transaction is recorded immutably, providing a clear audit trail while eliminating single points of failure. Liquidity, long a bottleneck in global finance, is being reimagined through cross-border liquidity pools. Digital assets held in these pools can be deployed instantly across jurisdictions, enabling near-instant foreign exchange settlement. Companies no longer need to pre-fund accounts in multiple countries or wait for intermediary banks to process payments, cutting operational costs and accelerating international trade. Atomic settlement further revolutionizes risk management. This technology ensures simultaneous exchange of assets, meaning payments and transfers occur at the exact same moment. By eliminating timing gaps, counterparties no longer face the risk of one party failing to deliver, dramatically reducing settlement risk for corporations and financial institutions alike. Interoperability between global blockchain networks is also improving. Different systems are beginning to communicate seamlessly, bridging previously isolated digital ecosystems. Standardized protocols and cross-chain messaging allow diverse blockchains to settle payments with one another, creating a unified network for international finance. For businesses and consumers, the benefits are tangible: faster transactions, lower fees, and increased security. For banks and regulators, blockchain provides visibility and control over every step of the settlement process. The future of cross-border payments is not just digital, it's instantaneous, transparent, and far more resilient, promising a global financial system where borders no longer slow the flow of money. Smart contracts are redefining the way money moves, turning code into a reliable, self-executing financial system. At their core, these contracts automate financial agreements. Predefined logic triggers payments automatically when conditions are met, eliminating the need for intermediaries and reducing human error. For businesses and consumers, this means transactions are faster, more secure, and fully transparent. Escrow processes and conditional transfers are perfect examples of smart contracts in action. In trade finance, funds can be released only when goods are delivered and verified, creating trust without traditional banks. Supply chain payments benefit too. Suppliers receive instant settlement when milestones are completed, improving cash flow and operational efficiency. Every step is recorded on a blockchain, providing an unalterable history of transactions that regulators and auditors can verify in real time. The tokenization of assets expands this concept even further. Real-world assets like real estate, stocks, or commodities can be represented digitally on blockchain networks. This opens the door to fractional ownership, faster trading, and more accessible investment opportunities for a broader audience. Essentially, physical or financial value can now move and be traded in a fully digital, programmable format. Transparency and trust are reinforced through open-source governance. Code auditing allows third parties to review and verify smart contract logic, ensuring that contracts execute exactly as intended and eliminating hidden risks. Developers, auditors, and users can all inspect the rules, creating a secure ecosystem where digital money operates predictably and safely. For Americans navigating digital finance, smart contracts mean payments that are instant, conditional, and auditable, asset ownership that is more flexible, and a financial system that is automated yet transparent. Programmable money is not just a technological novelty, it's a practical, tangible shift in how transactions, contracts, and assets are managed in a digital-first economy.
Stablecoins are transforming digital finance by combining the speed of cryptocurrencies with the stability of traditional money. Unlike volatile tokens, stablecoins are designed to maintain consistent value, making them practical for daily transactions, business operations, and international trade. Two main models achieve this stability. Collateralized stablecoins are backed by real-world assets like fiat currency or commodities, ensuring that each token has tangible value. Algorithmic stablecoins, on the other hand, rely on code-driven supply adjustments to maintain price consistency, automatically expanding or contracting token supply in response to market demand. Transparency is key to trust. Leading stablecoin issuers provide real-time reporting of reserves and undergo third-party audits, giving investors and institutions confidence that each token is fully backed. This level of accountability makes stablecoins a viable option for corporate treasuries, cross-border settlements, and large-scale digital payments, where predictability and reliability are essential. Liquidity management ensures stablecoins remain functional under heavy demand. Automated mechanisms handle token inflows and outflows, allowing instant redemptions and seamless circulation. Businesses can confidently accept stablecoins for payments, knowing the value will remain stable and accessible. Beyond retail use, stablecoins are increasingly integrated into commercial settlement and treasury operations. Enterprises can streamline accounts payable, payroll, and cross-border payments, reducing reliance on traditional banking corridors and cutting processing times. By bridging traditional finance with digital blockchain efficiency, stablecoins create a digital native environment for secure, predictable, and instant financial operations. For everyday users and corporations alike, stablecoins are more than a digital trend. They are a practical solution to volatility, a tool for transparency, and a foundation for the next generation of digital financial infrastructure. They are reshaping how money moves, settles, and grows in a digital-first economy.
Decentralized finance is reshaping global markets, and regulators are racing to keep pace with this borderless evolution. Unlike traditional banks confined to national jurisdictions, digital assets operate across multiple countries simultaneously, creating complex legal challenges. Regulators must decide how to classify cryptocurrencies, stablecoins, and tokenized securities under varying legal frameworks, balancing innovation with the need to prevent fraud, market manipulation, and systemic risk. Licensing and compliance are now central for exchanges, custodians, and digital asset providers. Companies must meet rigorous operational standards, including secure storage, transaction verification, and reporting obligations. Compliance frameworks ensure these platforms operate reliably, instilling confidence among both institutional and retail investors. By meeting these requirements, providers gain credibility and avoid costly regulatory penalties, ensuring that their digital services are legally sound and operationally robust. Technology plays a critical role in anti-money laundering efforts. Blockchain analytics, transaction monitoring, and behavioral pattern recognition allow regulators and providers to detect suspicious activity in real time. AI-powered tools flag unusual transfers, trace fund flows, and provide audit-ready records, significantly reducing the risk of illicit activity while maintaining efficiency in high-volume trading environments. Consumer protection remains a top priority. Digital financial services now include robust risk disclosures, multi-layered custodial safeguards, and transparent transaction reporting. Users gain greater visibility into how their funds are managed, how platforms secure assets, and what protections exist in the event of a breach or service failure. For Americans navigating the digital financial landscape, these regulatory measures create a safer ecosystem. They combine the flexibility of decentralized networks with legal accountability, ensuring that innovation does not come at the cost of security, transparency, or consumer trust. Decentralized finance is evolving fast, but regulation is helping it become a safe, scalable, and reliable component of the modern economy. Artificial intelligence is transforming financial infrastructure, making transactions faster, safer, and smarter than ever before. Fraud detection has evolved from manual reviews to sophisticated behavioral modeling. AI systems analyze patterns across millions of transactions, identifying unusual activity in real time. This proactive approach stops fraudulent transfers before they occur, protecting both consumers and institutions from costly losses while maintaining seamless payment experiences. Liquidity forecasting is another game changer. AI models simulate capital flows, predict cash requirements, and optimize asset allocation across complex portfolios. Banks and enterprises can now anticipate liquidity gaps before they happen, improving financial stability and reducing the risk of overdrafts or funding shortfalls. Risk modeling, powered by machine learning, allows institutions to simulate thousands of market scenarios in seconds, providing actionable insights for decision-makers. Compliance monitoring is also being automated. AI continuously scans transactions, accounting records, and regulatory reports, flagging anomalies or inconsistencies in real time. This reduces human error, ensures adherence to anti-money laundering (AML) and Know Your Customer (KYC) regulations, and allows auditors to focus on strategic oversight rather than manual verification. Even the underlying infrastructure benefits from AI. Machine learning algorithms optimize network throughput, reduce latency, and improve transaction routing efficiency. Payment rails, clearing systems, and blockchain networks all operate more smoothly, scaling to handle higher transaction volumes without sacrificing security or speed. For everyday Americans, AI enhances trust in digital financial systems. Payments become safer, cash management becomes smarter, and reporting becomes more transparent. For institutions, AI ensures operational efficiency, regulatory compliance, and reduced risk exposure. By integrating artificial intelligence into modern financial infrastructure, the entire ecosystem becomes faster, more secure, and better equipped to handle the demands of a digital-first economy.
Digital wallets and payment apps are reshaping how Americans interact with money, making banking faster, smarter, and more secure. Custodial wallets, offered by banks or service providers, store assets on behalf of users, simplifying transactions but relying on the provider's security. Non-custodial wallets, by contrast, give users full control of their digital assets, requiring private keys but offering complete ownership and independence. Understanding this distinction is key to choosing the right wallet for daily use or long-term holdings. Security is at the forefront of modern wallets. Biometric authentication, such as fingerprint scanning or facial recognition, combined with multi-factor verification, ensures that only authorized users can access funds. These layers protect against unauthorized access, fraud, and cyber attacks, making digital payments safer than ever before. Consumers gain peace of mind while maintaining the convenience of instant transactions. Digital wallets also seamlessly integrate with e-commerce and subscription services. One-click payments, automated billing, and recurring subscriptions become effortless, streamlining both personal and business cash flows. Users no longer need to manage multiple payment methods or remember card details, and merchants benefit from reliable, automated revenue collection. Real-time personal financial dashboards provide unprecedented insight into spending and savings habits. Users can track transactions instantly, categorize expenses, and monitor budgets, turning financial data into actionable intelligence.
This visibility empowers better financial decision-making, encourages responsible spending, and helps prevent overdrafts or late payments. For everyday Americans, digital wallets represent more than convenience. They offer security, control, and financial clarity. By combining instant payments, robust authentication, and data-driven insights, these tools are redefining the retail banking experience, bridging traditional finance with a fully digital, user-centered ecosystem that is fast, secure, and effortlessly integrated into modern life. Navigating digital currencies requires more than curiosity. It demands practical financial literacy to stay secure and make informed decisions. Understanding risk is the first step. Digital assets carry unique challenges. Price volatility can impact value quickly. Custody risk arises when holding assets with third-party platforms, and operational risk includes technical failures or human errors in transactions. Recognizing these categories helps users manage exposure and protect their investments. Online security is essential. Strong encryption, phishing awareness, and device hygiene are not optional. They are critical for safeguarding assets. Using multi-factor authentication, avoiding suspicious links, and keeping software up to date can prevent unauthorized access and financial loss. Simple practices like verifying website certificates and securing private keys dramatically reduce vulnerability. Evaluating financial service providers ensures your digital money is in trusted hands. Assess transparency, compliance, and reliability by checking licenses, audit reports, and customer reviews. Platforms that demonstrate clear reporting, robust security protocols, and adherence to regulatory standards offer safer, more reliable services, reducing the risk of fraud or mismanagement. Managing digital records and tax documentation is equally important. Digital transactions must be carefully tracked, categorized, and stored for reporting purposes. Maintaining organized records of transfers, receipts, and account statements ensures compliance with tax obligations and makes financial oversight easier. Cloud-based tools or secure local storage systems can help streamline this process. For everyday Americans, practical digital financial literacy transforms uncertainty into confidence. By understanding risk, securing transactions, choosing trustworthy providers, and keeping detailed records, users can fully leverage the advantages of a digital currency environment. This knowledge not only protects assets, but also empowers smarter spending, investing, and financial planning, creating a safer, more efficient, and fully informed digital financial experience.
Thank you so much for joining us on this deep dive into the world of digital currencies and modern financial systems. If you haven't subscribed yet, hit that subscribe button now to stay updated with the latest insights and breakthroughs. Show your support by giving this video a like. It really helps us reach more viewers. Share this episode on your social media to spread the knowledge, and drop a comment to let us know your thoughts and ideas from what you just learned. With your support, Relaxing Facts Studio can keep growing and delivering even more valuable, high-quality content.